You are listening to The Vocal Technologist. Spoken tech for your ears.
Welcome to the deep dive. I mean, just look at this massive stack of notes we have today.
Oh, it is a lot to get through.
It really is. It's pulled straight from the TLDR crypto newsletter from late May 2026. And, on the surface, if you just glance at these headlines, it really looks like a random assortment of market updates.
Yeah, totally disconnected.
Right. You've got a stablecoin launch over here, a highly technical protocol upgrade over there. It's kind of like looking at a city skyline at night and just seeing these isolated, individual lit windows.
Oh, just little dots of light.
Exactly. But when you step back and look at the whole picture, you realize you're looking at a massive hidden paradigm shift.
Oh, absolutely.
We are witnessing the complete collision of mature, institutionalized crypto infrastructure with the explosive rise of autonomous AI agents. And for you listening, whether you are a tech founder, a professional in traditional finance, trying to figure out where the industry is going, or just insanely curious about the future of money, this deep dive is going to be your ultimate roadmap.
Yeah, it's a huge shift.
We are looking at exactly how machines are starting to pay each other. Okay, let's unpack this.
It really is a seismic shift, but to fully grasp how and why these AI agents are taking over the network, we first have to understand the financial bedrock they're suddenly operating on.
Right.
Because the infrastructure had to change before the machines could actually move in.
Okay, so before we get to the robots, we need to look at the money. And that really starts with Bitcoin. I mean, if you've followed crypto for a while, you probably think of Bitcoin as this wild, stomach-dropping roller coaster.
Which it definitely used to be.
Oh, 100%. But looking at the market data from late May 2026, that roller coaster has somehow been dismantled and replaced by like a highly predictable scheduled commuter train.
It's wild to see the data.
It is. The 30-day implied volatility index just dropped to a 7-month low of 38%. And that's all while the price is just sitting comfortably near $77,300.
What's fascinating here is the underlying structural mechanism driving that stability. We are seeing unprecedented supply absorption by institutional players.
Wait, supply absorption? Like they're just buying it all up?
Exactly. Take MicroStrategy's actions in 2026 alone. They absorbed 171,238 Bitcoin.
Wow.
Yeah. And to put that physical reality into perspective, that is roughly 2.7 times the entire amount of Bitcoin that was actually mined by the network during that same period.
Wait, seriously? They are buying it almost 3 times faster than the underlying algorithm even allows it to be created.
Right. That creates a massive structural supply pressure that inherently anchors the price ranges. And then you add in the behavioral shift of the new market participants.
Like who?
Well, we now have mature ETFs, corporate treasuries accumulating the asset as a reserve, and highly sophisticated yield-focused funds. And those yield funds actively sell call options on their holdings to generate a return.
Okay, so they're trading against the volatility.
Exactly. When you systematically sell the upside like that, you are mathematically suppressing the wild price spikes that used to really define the asset. So the residual risk premiums, like the geopolitical fears we saw during the Iran conflict, they get priced in and digested much faster now. The asset simply behaves like traditional institutional-grade collateral.
Okay, but hold on. Wait. That maturation story doesn't really line up with the rest of the numbers we are looking at in the newsletter.
What do you mean?
Well, the data shows investors just pulled over $1 billion out of those supposedly mature Bitcoin ETFs.
Right.
And another $215 million out of Ether funds, and they did it specifically to chase high-risk, volatile HYPE funds. So if Bitcoin is this safe commuter train now, why are billions fleeing the station to go play in the casino?
I know, it looks like a contradiction internally, but it makes perfect sense when you factor in the broader macroeconomic environment. This is a direct collision with traditional finance.
Okay, how so?
We have 30-year U.S. Treasury yields hitting 5.18%. That completely changes the gravity of the market by creating a massive opportunity cost.
Ah, right, because of the guaranteed return.
Exactly. When the traditional so-called risk-free system is paying out over 5% guaranteed, it aggressively challenges Bitcoin's hard money thesis in the near term. Institutional capital just cannot justify sitting in an asset that simply holds its value if it yields nothing, while bonds are paying 5%.
So the money just flows to where the yield is most attractive relative to the risk.
Precisely. We're even seeing the oldest, most dormant players react to this dynamic. The newsletter tracked a Satoshi-era whale moving over $200 million in Bitcoin to institutional trading firms like FalconX and Cumberland.
Wait, the Satoshi era whale? Like someone from the very beginning.
Yes, and they aren't cashing out to buy sports cars. They are moving those dormant assets to trading desks to generate active yield because the traditional bond market is dictating the global tempo right now.
Okay, so if macro yields are sourcing these massive institutional whales to demand active returns, the actual plumbing of these blockchains has to be totally ripped out and rebuilt to accommodate them.
Oh, absolutely.
Because you can't invite Wall Street to the party if your infrastructure is fragile and, fragmented. We see this exact plumbing upgrade happening right now with Berachain's move to proof of liquidity V2.
That's a huge shift for them.
It is. Reading through their V1 setup, it honestly sounded like a corporate compliance nightmare. You had the native BIRA token, which was essential for network security, but to actually extract any yield from it, holders were forced to wrap their tokens in third-party smart contracts.
And that introduces a critical structural disconnect. You have an asset that secures the network, but to capture its value, the user has to take on secondary smart contract risk.
Which institutions hate.
Exactly. If that third-party wrapper gets hacked or exploited, you lose your underlying collateral. A traditional institutional compliance department will simply block that trade. The risk profile is just too messy.
Right, and V2 internalizes that process beautifully. They are routing 1/3 of all future network emissions directly into a new native BR yield module.
It's so much cleaner.
It really is. Now, an institutional fund can just stake their BRERA directly with the protocol itself. They earn rewards in the same asset, and they contribute to the network's liquidity depth.
Yeah.
It's all reduced to a single on-chain transaction.
Yeah, no more wrapper intermediaries.
Exactly. No more third-party smart contract risk. It cleans up the entire value capture story to directly appeal to those massive asset allocators we were just talking about.
And we are seeing this exact same push for institutional grade reliability playing out on Ethereum, but on a much grander strategic scale.
Definitely.
Vitalik Buterin and the Ethereum Foundation are executing a monumental pivot. They are anchoring the network's entire future around what they call the CROPS properties.
CROPS. So that stands for censorship resistance, openness, privacy, and security, right?
That's right. The foundation recognizes that their original token sale mandate from a decade ago is totally complete. I mean, they now hold only about 0.16% of all ETH.
Which is tiny.
It is. So the plan moving forward is to sell less of it, move their most respected contributors out of the foundation to attract external decentralized capital, and crucially, Vitalik is deliberately decreasing his own personal authority over the network.
See, I am genuinely stuck on the timing of this move. Vitalik is stepping back to decentralize power. But the newsletter details how Ethereum is simultaneously making this massive, urgent push for AI-assisted formal verification.
Right, the security up there.
Yeah, they are trying to use AI to mathematically prove their code is completely bug-free, right at the exact moment AI itself is becoming the biggest threat to digital security. Doesn't stepping back right now just remove their most trusted general from the battlefield when the network needs him most?
It is a really critical question of leadership versus resilience. But for you listening, consider the financial reality outlined in Buterin's own disclosure. He's keeping roughly 90% of his entire net worth in ETH.
Okay, so he's not cashing out.
Not at all. He is allocating about $40 million in on-chain fiat to open source biotech and hardware initiatives. He isn't abandoning the ship. His wealth is completely tethered to its success.
So it's more of a, passing the torch moment.
It's a strategic repositioning. He knows that for Ethereum to really serve as global infrastructure, it has to survive and function flawlessly without a central human figurehead.
That makes sense.
That's why their technical priorities are entirely focused on hardening the protocol. They are pushing new technical standards designed to minimize the power of the massive intermediaries who build the blocks of data.
Because they want to make sure the network stays decentralized.
Right. They want to ensure that absolutely anyone can still see and access the public waiting room of transactions so that no single massive player can hide or censor data. They are bulletproofing the underlying code because the next massive wave of users they are building for are not human.
Okay, here's where it gets really interesting. The push for these mathematically bug-free, highly secure networks perfectly sets up the most mind-bending data point in this entire stack of sources.
Oh, the AI payments.
Yes, blockchains are officially becoming the default payment layer for AI agents. Between May 2025 and April 2026, autonomous AI agents settled $73 million across 176 million individual blockchain transactions.
The ratio in those numbers is the entire story. 176 million transactions just to settle $73 million.
Right, because using a traditional credit card for an AI micropayment is like hiring an armored truck to deliver a single penny. It just doesn't work. The legacy financial rails are physically too heavy and too expensive to support machine commerce.
It fundamentally breaks the traditional payment math. I mean, the legacy card network relies on fixed interchange fees, usually a flat fee of 10 to 30 cents, plus a percentage of the transaction.
So a tiny payment is impossible.
Exactly. It mathematically cannot process a 5-cent transaction without operating at a loss. The data shows that 76% of these AI payments fall entirely below that traditional 30-cent minimum cost threshold.
Wow, 76%.
Yeah, so the machines had to find a different rail, and the asset they chose is USDC. That specific stablecoin captured an astounding 98.6% of all machine-to-machine payment volume.
Okay, let's talk about how these machines are actually spending that USDC, because the source gave a brilliant example of the mechanics at play. There is an AI agent named Hermes.
Right, the forensics agent.
Yeah, Hermes runs what is called an on-chain forensics pipeline. It executes incredibly complex data polls that would take a human analyst hours. I mean, it scans Dex Screener for liquidity pools, cross-references, Nansen smart money flows over 24-hour, 3-day, and 30-day windows, estimates wallet ages, detects deposits to centralized exchanges, and checks token unlock schedules.
It's doing all of that instantly.
Yes. It synthesizes all of this fragmented data into a unified investment verdict. And it pays for these data pools using by 402 micropayments. It costs the AI literally 3 to 7 cents per run.
The efficiency gain is just staggering when you look at the real-world application. It turns what used to be a fragmented mess of $100 monthly software subscriptions into a $1.50 task for a batch of 20 runs.
That is insane.
It is. There are no API keys to manage per provider, no recurring monthly fees to cancel. The developer even built a skill bundling feature that packages these complex queries into one reusable command. The AI simply executes the logic and streams the fractions of a cent as it works.
Okay, but hold on. If USDC controls 98.6% of all those machine payments, are we just trading one monopoly for another?
That is the big fear, yeah.
Like, we are replacing the decentralized promise of crypto with a massive concentration risk centered around a single corporate database run by Circle. If they change their terms of service, the whole AI economy just freezes.
The tech and finance giants see that exact structural vulnerability, and it has kicked off a massive corporate arms race to build alternatives. They know that whoever controls the settlement layer controls the future of digital commerce.
So who's jumping in?
Well, Coinbase is actively deploying their by 402 protocol to standardize these machine payments. Stripe just released their complete stablecoin playbook and is aggressively using their machine payments protocol on platforms like Tempo.
Oh, wow. So the big players are serious.
Absolutely. Google is building out AP2, and Visa is developing tokenized credentials specifically for smart contracts. They are all desperately building competing settlement infrastructure because they are racing to capture a market that is projected to hit $15 trillion in intermediated purchases by 2028.
$15 trillion in machine commerce.
It's massive.
So while these AI agents are seamlessly gliding across crypto rails for pennies and tech giants are fighting over a $15 trillion pie, the traditional financial system is buckling under the weight of these exact same AI advancements.
They really are struggling.
Let's look at the European Central Bank. The ECB is actively summoning European banks to crisis meetings to deal with Anthropic's Claude Mythos AI model. This AI has reportedly identified thousands of zero-day vulnerabilities in bank code.
Thousands. That's terrifying for them.
Right. Legacy banks built their security like a massive heavy stone wall. It's designed to keep out human hackers, but it takes months for a committee to agree on how to patch a hole. But the Mythos AI isn't a battering ram, it's a fluid.
That's a great way to put it.
Thanks. It finds microscopic cracks in the code, writes a custom exploit, and slips through before the human security team even schedules a meeting to look at the anomaly.
And the regulatory panic we are seeing from the ECB is entirely justified by the mechanics of the threat. The ECB executive, Frank Elderson, highlighted that the window between a vulnerability being discovered and it being actively exploited has virtually collapsed.
It's instantaneous now.
Exactly. It used to take weeks for hackers to weaponize a flaw. Now the AI does it in seconds. European banks are facing a massive technological access gap to models like Mythos, and regulators are demanding they resolve this under the DORA framework.
What's the DORA framework again?
It's Europe's new mandate requiring banks to physically prove they can withstand severe digital disruptions. And at the same time, you have fintech companies desperately trying to upgrade their legacy infrastructure to move faster. They are petitioning for expanded access to Fedwire via special purpose payment accounts to achieve true any real-time settlement.
Because they want to compete with the speed of crypto.
Right.
But they are running straight into the artificial roadblocks of the legacy system itself.
They are entirely bottlenecked by legacy constraints. Specifically, there is a $1 billion cap on overnight closing balances for these accounts. In a 247 automated AI economy, money has to move on weekends and in the middle of the night. But Fedwire literally shuts down.
It goes to sleep.
Exactly. That overnight cap means these fintechs literally run out of settled liquidity while the traditional banks are closed. The traditional pipes simply weren't built for the velocity, the volume, or the 24-hour nature of an automated, AI-driven world.
Okay, but we saw in the quick links section that advances in AI are actually accelerating the timeline for practical quantum threats to cryptocurrency cryptography.
Yes, that's true.
So if AI is fluidly hacking legacy banks and forcing emergency ECB meetings on one hand, but AI is also turbocharging quantum computing attacks against blockchain protocols on the other, is the blockchain actually any safer than a traditional bank? Or are we just picking our preferred flavor of digital doomsday?
If we connect this to the bigger picture, the survival of either system comes down entirely to the speed of adaptation. Yes, it is an arms race across the board.
Okay.
The legacy financial systems are under severe attack, but their defense mechanisms, relying on slow human patching of monolithic code bases, convening risk committees, or appending on Fedwire's artificial liquidity limits, they are inherently sluggish.
Right, they can't keep it.
But the crypto rail, by contrast, is evolving into a live, real-time battlefield between AI attackers and AI defenders. Remember the Ethereum Foundation's strategic pivot we discussed earlier?
To push for AI-assisted formal verification.
Exactly. That is the network's immune system adapting. They are using AI to mathematically prove the code is impenetrable, adapting in real time to the exact quantum and AI threats you just mentioned. The blockchain can upgrade its foundational physics. The legacy banks simply cannot.
Okay, so what does this all mean? If we step back and look at the whole picture, all those individual lit windows in the skyline we talked about at the start, we're essentially watching the handover of our global financial infrastructure.
That's exactly what's happening.
On one end, humans are actively maturing the crypto market. We're filling it with ETFs, corporate treasuries, and deeply integrated compliance structures like Barachain's native yield module. We're actively taking the volatility out of the system. But we're doing all that just to quietly hand the operational keys over to autonomous AI agents like Hermes, who are already out there executing millions of microtransactions for pennies while the legacy banking system freezes overnight. The real heavy-duty users of tomorrow's financial system just aren't going to be human.
And that transition to a non-human user base brings up a profound vulnerability, which leads to a final, rather unsettling thought from our sources today regarding the state of base, AI, and open human.
Unsettling how?
Well, we are seeing the explosive rise of permissionless launchpads platforms like BankerBot and PumpFun that allow totally anonymous actors to spin up new tokens instantly.
Okay, sure.
And these actors are writing code that routes trading fees to random GitHub repositories or social accounts of prominent developers. They are artificially manufacturing false endorsement signals on the blockchain, exposing completely uninvolved innocent founders to coordinated harassment from traders who think they are involved.
Oh, wow, so it's faking trust.
Exactly. So, for you listening, I really want you to mull this over. If AI agents are doing the vast majority of the trading based on on-chain data, and anonymous code is actively faking human endorsements to manipulate those very agents in a fully automated, machine-driven financial system, what does trust even mean anymore?
Man, if the lights in the skyline are just machines tricking other machines into allocating capital, who is actually in charge of the city?
That's a great question.
That is a wild, wild thought to leave off on. Thank you so much for joining us on this deep dive. Whether you are actively building this automated future or just trying to navigate it, keep looking closely at the data and keep questioning the digital world around you.
Spoken Tech for your ears.